I'll talk about depreciation then a little bit.
Oh, excellent. Depreciation is a part of it because when you own a property, there's a tax rule that says that every year you can take a part of it and assume it's worth less the next year. It's depreciating, kind of like I always think of depreciation as like in a short-term example would be like a head of lettuce. If you bring a head of lettuce home and you sit it on your counter, it's gonna wilt over time.
Right.
You gotta eat it the first day or two. Now, real estate isn't quite like that, but the tax laws kind of let you assume it is. Kind of like every year, a little bit of it wilts, so it gets a little worth less than it was the year before. No matter what you do to it, you can depreciate a portion of it, 2.5% roughly, every year on your taxes. It's one of the tax benefits of owning property because it doesn't cost you anything to depreciate it, but you can take that as a expense, so to speak, against your income on the property at the end of the year. It's a way for you to kind of offset some income, and then you recapture it when you sell
How do you recapture it? It sounds mostly like a negative thing, the way you describe it.
It's a negative thing, but the way it's a positive thing is if you have income on that property, but then you depreciate a portion of it, that can reduce your taxable income for that year. Okay, so it's year by
So it
year the
reduces your
depreciation.
tax liability.
That's right, per
Oh,
year based on your income on the property, and the end to you don't care because then at the end you get it back. It's really totally an accounting number. It's made up. You and I know that depreciating a property over 40 years is totally arbitrary. Some accountant at the IRS has set that rule, and it's crazy that that's what it is, but that's what they set. So that sets the limit that you can depreciate at approximately 2.5% annually. Again, my CPA does this for me. I just only know this from working with him and working through him. And you too would need a CPA to look at your specific case. But that depreciation, you're right. It sounds negative. You think, well, I don't want to make my property worth less. You're taking that $25,000 in this case on $1 million
mm.
property, and you're able to put that against some of the income of that property and get lower taxes. It's a good deal.